Hey guys, I hope you are all having a good week so far. A little different format than our typical videos, but I hope you enjoy it. And the reason that I wanted to make today's video is because we've talked about two categories under a certain context in the past. We've talked about homeownership, but most of the times when we talk about homeownership, it's under the context of buying your first home or managing your primary residence. And we've talked about investing, but most of the time that means stocks and bonds and mutual funds. But one area where we haven't covered as in depth is real estate investing. And I know that there are a lot of you out there who are just as interested in becoming the next real estate mogul as you are becoming the person who understands how to pick stocks, bonds, and mutual funds. So I wanted to make a video for you guys today. And one of the things that we're going to cover is more so for people who are interested in having rental property. And we are going to cover today the 8 steps that you can take before buying a rental property. So let's get into it. 8 steps before buying your first rental property. The first step is to prepare for a big down payment. Now, one of the things we've talked about in the past is the down payment on a home and the importance of bringing 20% to the table as a down payment in terms of your home's value when you apply for your primary residence. So if you have a home that's worth $100,000 and you're getting a conventional home loan, a lot of lenders are going to want you to bring at least 20% of that home's value to the table. And if you don't, you may be able to get into that home, but you will likely have what's called PMI or mortgage insurance premium added onto your payment. Put simply, that is a premium. It's a premium that's put on your home loan that says your lender is worried that you might default on that loan. So they're going to give you the property, but they are going to charge you an extra amount for doing so. When you have a rental property, that works a lot differently because with most rental properties, conventional loans, they want you to have that full 20% or you will not get the property at all. They will not let you do like an FHA loan where you only put 3.5% of your home's value down, but you can still get the property. With an investment property, they're going to ask you to come up with their 20% down payment in full to qualify for that home loan. Now, there are some caveats to this, specifically when it comes to an FHA loan. If you have an FHA loan where you have that 3.5% down payment and you're buying a rental property that is a duplex or a triplex and you are living in one of the units, there is a possibility that you could qualify for an FHA loan. But typically, you are going to want to have a much bigger down payment for a rental property than you might have to have when it is your primary home. So step 1, prepare for a big down payment. Step 2, prioritize emergency savings. Now, ideally, you buy a rental property and you have a quality tenant in place before you even close on the loan. And that tenant would stay for 20 or 30 years. They would consistently requalify and renew their lease, and that property would never sit vacant. You would never have to have any repairs. But I think we all know that that is unlikely to happen. There will be times when you don't have a tenant and you have to float the note for a few months, and HVAC systems will go out. You'll have to replace the shingles on a roof. There's all types of things that can pop up when you have a rental property. And as far as repairs go and having an emergency savings for your rental property, you want to, as a rule of thumb for me, it's just my personal feeling, have at least a couple months expenses for that rental property saved in addition to the emergency savings for your primary home. So it's not enough to have an emergency savings for your primary home. You want to have a separate amount that you've put aside to cover the expenses of that rental property specifically. So step 1, prepare for a big down payment. Step 2, prioritize emergency savings. Step 3, examine your cash flow. So when you're talking with clients, or when I'm talking with clients about investment properties, I often encourage them to only get an investment property if they know that they can cash flow the payment for a few months if that property were to sit vacant. Now, I know that seems like it's contradictory to my previous point where I said you need to have that amount saved in cash in your emergency savings, but there's a reason that I have this rule when it comes to investment property. And it's because I never want you to get into one investment in a way that stops you from doing other investments. Here's what I mean by that. One of the biggest determining factors in whether a lender will give you a home loan or not is your debt to income ratio. So we've covered this in the past. Debt to income ratio is an expression of how much of your monthly income is swallowed up by your debt payments each month. So if you have a $10,000 monthly income and your debt payments are $4,000 a month, that means you have a 40% debt to income ratio. And many lenders, you'll find that they want your debt to income ratio in the low to mid 40s if they're going to approve you for a new home loan. So if you can set the goal of being able to cash flow your rental property in addition to the other things in your finances, then even if you don't have to do it, what you're showing the bank is that you're putting yourself in a pretty good position and that you haven't bitten off more than you can chew. And it makes it more likely that you'll be able to qualify for another rental property in the future if they know that every time you apply for a home, you're doing so in a way where you don't have to have a fully paying tenant in there to make sure that that mortgage gets paid every month. This way, your home's finances, your primary home's finances, can't be negatively impacted by an unexpected expense or a tenant that is taking a little while to get into that property. You have it in savings and you know that you can cash flow that property. Very important. Fourth, find a property manager. So I'll tell you, using a property manager for rentals is definitely personal preference. And property managers, they do things like they locate and place tenants, they handle complaints and repairs, and in worst case scenarios, they'll even evict tenants for you. And some property managers, they charge a percentage of the monthly rent as their payment, and others charge a flat fee. Now, you can certainly handle all those things that I talked about yourself, and that introduces a crucial decision you'll have to make as a landlord, and that is, do you want to do it yourself and save every dollar you can, which would make you an active manager, an active landlord, or do you want to take a haircut on your profit in exchange for those things being taken care of by somebody else, which would make you a passive landlord? You know, speaking from experience, I can tell you that I hated actively managing the problems that popped up as a landlord, to the point that it actually discouraged me from rentals for a period of time, a number of years. You know, it not only takes a special temperament to be a landlord, but it also takes the time and the aptitude to deal with these issues that pop up. And even if you have two of those things, but don't have the third, you might find yourself in a position where you need to be a passive landlord. So even if you have the time and the aptitude, but not the temperament, you want to potentially look into a property manager who can take some of these things off of your plate for you. So step 4, find a property manager. Step 5, dig deeper on your property taxes. Now, property taxes on a rental can be paid separately, or they can be lumped into the mortgage payment for that rental. And if you have a primary residence and rentals, these taxes are often based on a percentage of your home's value as calculated by your local property assessor. And there are often caps on how high those percentages can reach. But unfortunately, the caps on a rental property are often higher than what they'll allow for a primary residence. So you might have property where you are living in that home and the property tax rate is not that high, but on your rental, it could be significantly higher depending on the rules of that area. And oftentimes when you look at the listings for these rental properties, they're listed by somebody who might be selling the house and they lived in the house. So when they're giving you an estimate, it might be on whether you are going to be an owner, occupied owner, but not, if you're going to be a landlord. So what I would consider doing is call your county tax assessor and ask how they view property taxes for investment property, and make sure the numbers that you're crunching in terms of whether or not it's a good deal are accurate when you're planning for that rental's monthly expenses. Step 6. So dig deeper on your property taxes, but also your homeowners association. I cannot tell you how important this is. So the homeowners association is the association to which your property belongs, and it can be your best or worst nightmare. And annoying as it may sound, some of the standards that these HOAs impose on their communities, such as requiring regular landscaping and restricting noise levels, they can, on the positive side, provide some uniformity to your neighborhood and possibly increase property value. So there is a method to the madness. But on the other hand, there are HOAs that can enforce rules that are really cumbersome and they can lead to heavy fines. So you want to make sure you know those things in advance. And keep in mind, you're not going to be the only one who's going to be enforcing the rules. This is a rental property. So when you're doing this, you have to keep in mind that your tenant will also have to adhere to these restrictions as well. So if you have an HOA with a laundry list of rules, it might be an added burden to monitor your tenants to make sure that they're adhering to those regulations. So you want to make sure that you check into not only those things, but also an understanding of whether that HOA will allow you to do some of the steps that you want it to take full advantage of that property. For example, you might be buying that rental with the intentions of doing Airbnb or VRBO, but you might find that your HOA association or your homeowners association, forbids you from listing on those properties, and you could be reported if you ignore that regulation. Additionally, you want to make sure that you really assess the financial strength of that HOA. So what happens in an HOA is there's some things that are responsibilities of the homeowners, but there are also some things that are responsibilities of the HOA itself. So if something happens to your neighbor and the HOA is on the hook, then basically they are pooling the HOA fees from all of those other homeowners, and they're using that money to pay for those repairs. Now, if you're with an HOA that does not have a strong financial backing and something happens and there's not enough HOA money in reserves to pay for that need, HOAs are allowed to do what's called a special assessment, meaning that they can assess how much of that new bill is the responsibility of each homeowner, and they can require you to come up with that money in cash within a certain period of time. So if you're dealing with a HOA that is not fully funded, if something comes up and they do not have that leverage, you could be the one that ends up partially on the hook for that additional repair or additional liability. So you want to know about your HOA as much as you possibly can ahead of time. So step 6, dig deeper on your property taxes from before and your homeowners association, which leads us to step 7. If you're going to be a landlord, you need to have an umbrella policy. So some of the things that we've talked about on your house are probably pretty obvious. You want to have insurance to protect that home from damage, but if you're renting out a property, you want to consider that there is an additional liability as well that comes from their ability to potentially sue you or someone who is visiting that home to sue you. And because of that, you want to consider an umbrella policy or a personal liability policy. And this is insurance that covers you if you're found to be personally liable for some of the things that could happen in that rental. So like I said, if your tenants were to sue you for an issue that's beyond the scope of what's covered by your HOA or your homeowner's insurance, an umbrella policy could help make up the difference between those two amounts. And these policies, they're typically pretty valuable even with one property, but if you're an investor interested in purchasing multiple, you definitely want to look into one of these policies. And fortunately, they are typically pretty cost effective. And if you're looking for one, you can typically find one with your property and casualty agent, or basically whatever company has your homeowner's insurance or your auto insurance policy. It is likely that they offer umbrella policies as well. So step 7, buy an umbrella policy, which brings us to the last step, and that is avoid the fixer-upper. Now, we've talked about determining what type of landlord you want to be, but I'll tell you, it is very important with any investment to determine the end goal before you start. So before you dip your toe into investment real estate, you want to know, are you looking for quick cash, or do you prefer having a steady recurring revenue? Now, if you're looking for quick cash, it sounds like you might be a candidate for flipping homes, where you buy a property, you invest money to increase its market value, and you hopefully sell it for a profit. And in my opinion, flipping houses with no experience is a really risky way to dip your toe into investment real estate because you have to either be handy enough to manage those repairs and upgrades yourself, or you have to have relationships with contractors and be able to manage the construction budget and the timeline of that project. And neither of those things are easy to do. For these reasons, I think starting off with a rental property that can provide steady cash flow is a better bet for beginners. And when the goal is cash flow, it's less risky to find a property that only needs light work to be ready for tenants. So for example, new carpet or just a paint job, than it is to find one that's in need of heavy repairs. So if you're thinking that completing those repairs will do wonders for the home value, that's a flipper's mindset. But now, if you're looking for steady income, you can be a landlord at a house flipper at the same time, but not with the same house. So if you want to flip a house for quick cash flow, and a home that's in need of heavy repairs might be a good flip, but you don't want to have that mindset and also try to use it for steady income as well. It needs to be either or, especially when you're getting started with investment finance. I hope these tips were really valuable for you today. We cover a lot of things on this channel, but I always try to make sure that it's things that add to you guys' financial life. If you don't like these videos, I actually want to hear your constructive criticism, because we want to make sure that they are always useful to you. As always, I would love for you guys to make your way over to some of my channels so that you can hear more of our content. We don't just do videos, we do blog posts as well. So if you're looking for me, you can find me on my website, www.brentonharrison.com. You can find me on Twitter at BrentonHFG. I'm on Facebook, facebook.com/BrentonHFG, and also on YouTube. So if you're looking for my YouTube channel, sometimes we post videos there that we don't post on Facebook. That is youtube.com/C/BrentonHarrison. So I thank you guys for tuning in today. I will tell you we will have more in the future, but I would definitely encourage you to find us on all of those platforms so that you can be the first to see the new material that we have. Thank you for your support, and I hope to see you guys soon.